let's come to the discussion for the day. Can you do what Isaac Newton couldn't? So we all know Sir Isaac Newton's scientific achievements and thesis, but let's not go there. We also know that he was a avid investor, and we want to follow his journey in finance and investing and see uh, where that led to. So this is basically late 1690s, early 1700s. That is the time period in which he was relevant. He was the warden and master of the Royal Mint. He was managing England's coinage. He led the great recoinage, replacing clipped and faked coins with new trusted ones. So, as you know, a currency becomes older and older, you start to clip the edges. You start to sort of mix some alloy in it, and that's how the gold standard at that point of time was getting misused gradually. But he was in the currency reform team. Counterfeit crackdown. So Newton personally chased, prosecuted, and even executed major counterfeiters, and his policies shifted Britain closer to a de facto gold-backed monetary system. So this is just background of where and what he was doing. Of course, he was super intelligent and one of the highest IQ persons out there. But behavior and intelligence may not be correlated. That is the core point that one is trying to drive at. That you may be super intelligent and you may be a master of your domain, but is that going to help you in your behavior when it comes to investing? And are they correlated or not? So we'll talk a little bit about the South Sea bubble. This was like one of the first bubbles of the financial markets. You can say this was 1710 to 1720 or so. So this company was made by the Act of Parliament in UK, in Britain, and uh, and this company was basically to manage Britain's debt, and it was given the trading rights that whatever trade Britain does with South America will go through this company. So it was a specialized company made by Act of Parliament, and is a huge speculation or a speculative frenzy started on this stock. It was a listed stock, and stock prices rose as this company was told that okay, you take over the debt of Britain, and instead you can allocate stock, and you know the stock was promised certain percentage of dividend to be given out. So everything looked very hunky dory, and hence prices just went up of the stock price. uh, and they just kept going up like from 10 pounds to more than £1,000 in just matter of months. And by the time the market figured out that this is not possible, you can't wish away the debt, you can't wish away, and the trade with South America wasn't so great. So entire thing collapsed down on its own self. So investors were ruined, corruption was exposed, political heads rolled in Britain's first big financial scandal. It was a big scandal. It was like the next bubble after tulip mania. Now Isaac Newton also participated in this bubble, and he invested a little bit in 1720 as it started to go up from 100 to 200 pounds, December 1718, and within a few months he made 2x of his investments, and he exited, just like all smart investors, or you may say, or anybody who's sort of very happy to just make some money on their money and get out. So a lot of uh, you know folks will not wait for more. They're happy, they're satisfied with so much. But then the next phase starts where FOMO starts. The stock is continuously going up. You bought at 200, you sold at 400, now it is 500. Now the next week it is 600. Your friends are getting rich. There is FOMO. I mean, why did I sell out at 400? Or why did I not buy enough at 200? A lot of herd behavior starts. You meet anybody and they're asking you, I hope you are still having South Sea stock in your portfolio. We've all, gone through these cycles with some stock or the other. And at some point of time, you bought at 200, you sold at 400, you got FOMO at 500, 600, 700, 800. You said, let's buy it again. The stock is going to 5,000, right? And you buy it with big lots, uh, determined to make a lot of money this time, because one is a point also of self assurance, because you've already tasted blood. any stock which has given you gains in the past somehow becomes like a high confidence stock. Oh, this stock has given me money earlier also, this time also I'll make money on it. So this becomes like a confirmation kind of a situation, whereas any stock which have lost you money earlier, you probably will remain a little cagey about that stock. So here, Newton enters again, uh, completely blinded by greed, of course. Recency bias in big way, 200 to 800 has happened in just few months. And, the bubble goes on to near £1,000, and then it starts to crash uh, once the market realizes what it has been doing, and it just collapses back to 200 $100. Newton enters at 5 600, gets out at couple of hundred, and is broke. Basically, whatever leverage or whatever borrowing he did for investing in the stock has gone, uh, and within 3 months he's lost a significant amount of money. He has to declare bankruptcy and so on and so forth. Completely broke. So what has happened here? A perfectly brilliant person who is in the business of coinage and catching counterfeiters. Just imagine that person's brain. I mean, how brilliant he is, but that brain also gets swayed by emotion, by FOMO happening around you, right? So essentially, that lack of plan, lack of action, lack of foresight of planning what to do, even after you've entered at, I say, even if somebody's entered at £1,000, there should have been a plan what to do if it comes to 900, what to do if it comes to 800, what to do if it comes to 700. You can't be the deer in the headlight of a car and just stunned, I don't know what to do. That should not be happening. So lack of plan can be catastrophic, even if the idea is great. So a lot of times when we pick stocks, the idea is fantastic. I mean, discretionary investors will not sleep the night they get the idea, because the mind is constantly working on that idea. You are doing self confirmation. Middle of the night you are waking up and checking out some facts about the company again, and reconfirmed that tomorrow morning I have to buy this, come what may. This is going to be the next whatever stock that just goes up like that. Next HDFC Bank, perhaps. So what to buy, when to buy, how much to buy, when to sell. All that doesn't come to your mind at that time. The only thing that comes to mind is that I need to buy it, and I need to buy it fast. 9:15:01, I need to buy this. So there's a lot of learning from others' failure. A lot of people have experienced so many things. I mean, just imagine there are 10 crore investors in Indian market itself, or probably more, and everyone has an experience that you can learn from. And this is the biggest advantage for the current generation. So, for instance, if I entered the markets in 1995, I could talk to a few people and learn from them what is their experience, even if they wanted to share or not, that is another query. But today's world is so connected, and there's so much of YouTube and this and that happening. You are so learning so fast from others experiences that your own learning can go very exponential because of this ability that you have, that you can learn from others, and there is so much available to absorb. So, what should we learn out of this is that markets don't reward IQ, they reward EQ. Success isn't about how smart you are, it is about how well you manage emotions. So, emotional quotient for the markets probably is much more important than intellectual quotient. You may be the most brilliant balance sheet reader. You may be the most brilliant forecaster of how a sector is going to move, how this is going to, change the shape of that particular segment of the market, how that particular marketing plan of that company will uh, succeed. But if you don't have that required emotional balance in your own self as an investor, all that is a waste. I can tell you this much. Rather, a average person but who has fantastic control over emotions, who can see things very clearly, standing, like taking a global view of himself doing this all this, and removing that self from that equation. That's how Alok Jain is working. I'm going to watch from a distance and manage how the emotions are. And that can really reward in a very, very big way. Even if your inputs are average, even if you are not the most intelligent person. So for me, intelligence is not important. Emotional strength is behavior more than strategy. So even if the best strategies fail, if you are unable to stick to them during tough times. So let's say your strategy is I'll buy when there's blood on the street. We've seen so many times there's blood on the street. Nobody's able to buy at that time. That strategy execution itself fails because one, why is there blood on the street? Because everybody is full till their necks with stocks. Nobody has capital now to put into the markets, hence there is no demand in the market, hence supply is overwhelming the demand, and hence the stocks are falling. So until there is a new money that comes around from somewhere, the market cannot go up. So it is very easy to come and say that buy when there is blood on the street. Well, you are also lying and rolling in that blood at that point of time. It is good only if you are standing apart outside that market and saying, okay, so the rest of the market has bloodied themselves. Now I'm going to enter. That would be a different thing. But most folks will get bloodied along with others. They will not have new capital to deploy, and the behavior will fail because at every point of time, and we've seen this just 10 days back at Nifty of what 21,700 or wherever bottom we made, there was zero confidence on that day that the market is going to go up from here. The confidence that it's going to 18, 19,000 was very high on that day. Intelligence cannot override emotion. So we've seen in this example how geniuses like even Newton failed when emotions took over. And it is human to have emotions take over, but with practice, with structures, with rules in place, you can harness that prowess of the behavioral control. If you will continue to practice a certain way of operation, you will master it. So instead of maybe failing 9 times in 10, maybe you'll fail once in 10. That kind of a difference can happen. You can never become a machine, but you can get closer to that. So the bottom line of this presentation was that we need to take control over our behavior. It is primarily the behavior which causes poor outcomes. It is not the markets. The markets are the same for everybody. Those who behave well in the markets do well. Those who don't uh, lie by the side. Do you agree with this fact or not? Do let me know your thoughts on this. And thank you so much for watching. And I'll see you in the next one. Bye.